Is the American dream dead? Well, sort of. Let me explain. At the moment, there's this belief out there that the American dream is dead because of housing affordability. Now, housing affordability is essentially a three-legged stool where each leg represents a piece of that affordability puzzle, if you will. So you have house prices as one leg, you have interest rates as another leg, and then finally you have wages as the third leg. So in order to address the idea of the American dream being dead, we need to understand each leg of the stool, where it's currently at and where it's likely headed. But before we dive into that, I'd like to take a minute and ask a favor that you hit that thumbs up to show support to the work that actually goes into creating these videos, in addition to subscribing to the channel to show your continued support. Now, before we get started about talking about the American dream dying, if you will, I want to get a few housekeeping items out of the way. And that's the idea that the housing market isn't crashing and it's not going to crash to make homes more affordable. So if that's what you're thinking or that's what you're wanting to hear so that you can get the possibility to buy a home, unfortunately, this video is not for you. This video is going to be talking about the pieces that make up housing affordability, in addition to what you can do as a home buyer to put yourself in the best position possible to buy a home. Now, the first leg of the stool I want to talk about in today's video are house prices. On average, house prices have increased somewhere around 4.6% for the last 60 years here in the United States of America. Now, that doesn't mean they go up every single year in a straight line. Some years they go up, some years they come down, but over a 60+ year average, home prices have continued to go up. And in my opinion, that's likely what you're going to continue to see over the next 60 years. But because we saw home prices appreciate so much in just a short period of time, nearly 30 to 40% in many US housing markets out there over the last 2 years, there's a really good chance that you see home prices move sideways. They bounce up a little bit, maybe they bounce down a little bit, depending on the market that you're located in. Now, with that said, we've recently gotten data from Case-Shiller that we've finally gotten a month-over-month increase with regards to home prices after nearly 7 months of declines. And part of that has to do with the spring buying season. Part of that has to do with interest rates moderating from the fourth quarter of last year. But it also has to do with the lack of supply out there in the housing market. Buyers can't buy homes that sellers aren't willing to sell. So what you have at the moment is still a lot of pent-up demand, if you will. And we've talked about this in other videos. Demand is made up of two different groups, the willing and the able. There's a lot of people willing to buy homes that want to buy homes, but can't for one reason or another. Maybe they don't have the credit. Maybe they don't have the down payment. Maybe housing affordability is making a play and they can't afford to purchase for whatever reason. So they can't transfer into the able. The able buyers are the ones that have the credit, have the down payment, want to buy homes, and can actually do it. And at the moment, you have more able demand than you have supply on the market, which is providing stability to house prices, pushing them up in some markets, but more importantly, keeping them from going down in many markets out there. With that said, at the time that we're shooting this video, the existing supply on the market today of active listings nationwide sits somewhere around 414,000 homes, which is quite a bit from where we set this time last year in 2022, but well below the 3-year average leading up to the craziness of 2020. Now, with that said, there's a lot of people out there that are talking about new construction. The idea that all of this new construction property is going to hit the market, and when that supply hits the market, that's what's going to create this catalyst, if you will, that's going to drive house prices down. Now, in some markets out there that have a lot of new construction, if there's already a lot of supply on the market, this new construction can, in theory, bring house prices down. And in some markets, it might do that. But here in Southern California, where I'm located, for example, there's not a lot of new construction. In fact, most of the new construction where I'm located are little infill developments where they're building 20, 30 homes at a time. Nothing to a large degree. There's no large-scale projects happening really in Orange County, outside of a few spots in Irvine and down near Mission Viejo, but nothing like you see in other areas of the country. And part of the reason is we just have a lack of land. Another reason for that is that it's also very, very expensive to break ground. It costs nearly $100,000 just to break ground on new construction here in California because of all the rules and regulations inspections and testing and things that you have to do in order to get that new construction to the next steps. But if you take a look at this chart here, there's somewhere around 6 months of supply that's currently under construction that's going to be finished sometime in 2023. And at the same time, you have somewhere around a month of supply that's currently finished and actively on the market. And while this might make a dent in the supply in the short term, it doesn't solve the long-term problem of us needing somewhere between 4 and 6 million homes to keep up with a growing population. In fact, if you look at this chart here, housing starts were at the lowest level that we've seen since 2019. And the real thing to pay attention to here is the one-unit properties, because those are single-family homes that are being built for people to actually buy and live in. Many of the 5-unit properties that you see on that chart are multi-family units being sold for investment purposes, which don't really help out with the actual supply. So in the short term, what I'm talking about here is the next 6 months to a year, you're going to see some additional supply come to the market for new construction, which could help with housing affordability depending on where those homes are being priced. If you're in a market that has a lot of new construction and they can't sell it, well, chances are builders are going to have to lower the prices or offer incentives, because builders aren't in the business of owning homes. They want to get rid of those properties. They want that cash back so that they can start on new projects. But at the same time, a lot of what happens around new construction and the deals that they're going to offer has to do with interest rates, which is the next leg of the stool that we're going to talk about. Now, earlier in the video, I mentioned that we saw an uptick in the month-over-month increase in home prices, and I attributed part of that due to interest rates moderating a little bit. And what I mean by that, as interest rates come down, that allows more people to buy homes, which in turn gives buyers more purchasing power. But on the flip side of that, if interest rates go up, that obviously hurts housing affordability, limits what home buyers can buy, and in theory decreases buyer demand. So the future of the housing market largely depends on the direction of interest rates. Now, earlier in the video, I mentioned that buyers can't buy homes that sellers aren't willing to sell. And the primary reason we're having this issue, if you will, this gridlock, is because there's a lot of sellers out there that are quote unquote locked into their homes, with 62% of the market having an interest rate below 4%, with nearly 39% of the market being between 3 and 4%. And this is the main problem with inventory, because sellers are choosing to stay in their home versus selling their home, even though they could potentially be a seller, somebody that wants to sell their home. Maybe they need to move because they have more kids in the house. Maybe they need more space. Maybe they want a different school district, or they want to be in a different area of town. But when they look at the market and they see that they would be going from, say, a 3% interest rate to, say, a 6 or a 6.5% interest rate, and that the same home that they bought back in, say, 2021 or 2022 that was priced at $800,000 is now priced for $9 or $950 or even $1 million, they're rather choosing to stay in that property versus paying a higher interest rate and in turn paying a higher monthly payment. And at the same time, even those that decide to sell, a lot of those people are turning that primary home into a rental property because the interest rate is so low on that property, and because rents have risen so much over the last couple of years, people are choosing to turn their primary homes into rental properties because of the cash flow it's creating, which is adding to the limited supply on the market. With that said, you've heard me talk about inflation in other videos. Interest rates tend to follow inflation. And last June and July, we saw the peak in inflation sitting somewhere around 9.1%. Whereas today, we have inflation sitting somewhere around 5%. So inflation has come down significantly, but it's nowhere near the Fed's target of 2%. In fact, 5% is much higher than the 2% target. And I'm not here saying that inflation has gone away, because it clearly has not, but we're likely to see inflation continue to moderate, especially as we start to see the rent and shelter data reflect what's actually going on in the market. Because it's a lagging indicator, it takes 6 months, a year in some cases, for that data to actually hit the inflation numbers. And we're really close to that happening. So as that starts to normalize, you're likely to see the CPI numbers improve considerably, which means that interest rates are likely to improve, which is likely to stimulate more buyer demand, which in turn, if interest rates come down and get somewhere between, say, 4.5% and 5%, you're likely to get some of those sellers that are locked into place to put their homes on the market, which in turn can start to generate some more activity. But here's the thing, even as interest rates moderate, it's not really going to improve housing affordability unless house prices stay the same. But I believe if interest rates come down enough, it's going to keep home prices moving up a little bit. Maybe not the 4.6% average that we've seen over the last 60 plus years, but maybe 1 or 2%. But what about if interest rates go up? Does that improve housing affordability? Because in theory, that would mean house prices come down. Well, I believe if interest rates continue to go up, say they were to go up into the 7% range and stay there for an extended period of time, that in turn would bring house prices down. But as I mentioned earlier, you have a lot of sellers that are locked into place, so those homes aren't likely to come to the market. So it's only those that need to sell, have to sell, that would really be impacted. And with that, you might be able to get a lower price on a house, but it's not going to be any more affordable from a monthly standpoint because interest rates have a bigger impact on your monthly payment than the price of that house. So lastly, with the three-legged stool, I want to talk about wages, because wages are one of those things that you can control at least a little bit that will help your housing affordability. Now, I know there's a lot of people out there talking about unemployment and people being laid off. Yes, I believe unemployment is likely going to continue to go up. There are going to be people laid off, people impacted by job losses, which in turn means some of those people are going to sell their homes, but I don't believe that's going to be the large majority of people. People fight tooth and nail to keep their properties, and because in many areas of the country, it's more expensive to rent than it is to own, especially when you have that interest rate at 3-4%, most people are going to choose to keep their property, which means you're not likely to have that supply getting to the market. And at the same time, I know a lot of people out there are talking about wages not growing, not going up. Well, if you look at this chart here, the growth of wages actually surpassed that of inflation for the first time since March of 2021. So we're still getting wage growth out there in the market. Now, I realize for many people out there, this isn't going to make a significant impact on housing affordability. The price of the house and interest rates affect that housing price more than anything else. But if you can put yourself in a position to make more money by getting a raise, by getting another job, by doing something additional on top of what you're already doing, that can largely add to your bottom line and in turn increase housing affordability. Now, I know for many people out there, that's not going to be easy. So what should you really be focusing on if you're planning on buying a house in the near future? Well, I think there's 3 things that you should really focus on. The first thing is become educated out there on the market. And what I mean by that is know your different options, know your different loan programs, know exactly what you're getting into and what you're trying to accomplish. Now, if you're a first-time home buyer, not sure where to start, well, I created a first-time home buyer course to guide you through this process from A to Z, everything you need to know to become an expert in this market, which I put a link to in the description below. But the second thing that you should focus on, and really the main thing here, is credit score. Credit score impacts your monthly payment, impacts your interest rate, your fees, your housing affordability more than anything out there. So if you can improve your credit score to the highest tier out there, you're going to put yourself in the best position to buy a home regardless of which loan program you're using. Now, I know there's a lot of information out there at the moment that high credit score borrowers are now subsidizing low credit score borrowers with these additional fees. And here's what I want to tell you. Having higher credit scores is still a much better deal than having lower credit scores. Yeah, lower credit scores, maybe the rates have improved a little bit, but you still get hit hard with fees, with underwriting guidelines, with mortgage insurance, all of that stuff. So it pays to have good credit. And the last thing you really want to focus on is down payment. If you're able to increase your wages, put more money away, pay off debt, then ultimately you're going to put yourself in the best position possible of being able to accomplish that American dream of owning a home.